Okay, so chapter 8 is really, we're going to be diving deeper into the topic of receivables. Um, so again, receivables. We've already talked about what receivables are, I think, since the chapter 2 or even chapter 1. But now we're going to be talking about a little more detail. We've been assuming certain things about the receivables, i.e., that they're all going to get paid, right? But that's not the reality because people will not always adhere to their obligation to pay you money. So we're going to talk about how that is accounted for. Um, so we're going to have two kind of different methods, the direct write-off method and the allowance method. So we're going to talk about the difference between these two and how they're related to this idea of bad debts, meaning you've extended credit to your customer. You've provided them services or sold them something, and they're owing you money, but they don't pay you back. How do you uh, account for that? And there's two different ways to do it. Okay, two different broad methods, and so we'll talk about both of those. Um, And then within this allowance method, there's like extra details. There's three kind of different methodologies. So the percent of sales, percent of receivables, and aging of receivables. So we'll talk about within this allowance method, these three different sub methods, you can say. And then besides accounts receivable, we've mentioned that there's this thing called notes receivable. Does anyone remember what the difference is between an account receivable and a note receivable? Exactly. Yeah. They're usually longer term. They're going to be formalized by some contract. There's going to be a loan agreement between the parties. So we'll just talk a little bit more about that, how to compute the interest, which we've kind of touched on, but we'll spend a little more time with that just to get some extra practice. And then also what happens when those notes receivable are not paid. So how we deal with that. Then we have some ratios at the end that we'll talk about. Okay. So again, this should be review, but again, it's good to, I think, repeat certain things, certain concepts, just to make sure that we're all clear. So when you have this receivable that's created, it's an asset, right? Accounts receivable is an asset account. Um, there's an implication that your business has extended credit to your customer. Okay. Um, so you, as the creditor, if you are the one that has the account receivable, you fronted something. Okay. Either you've given your customer some goods, you provided some service, or you've provided some asset to your customer. Okay. So what does the bank do? What asset are they giving their customer when they um, have an account receivable that's created? What do you think? What is the bank when you get when you use your credit card, your Chase credit card? What is the bank giving you? A loan, but what is the asset that they're giving you? Money, cash, right? So they front you cash, and then they have a receivable, right? You owe the bank money plus interest. That money back plus the interest. So in all these cases, the creditor is giving the customer something. Okay, either one of these three things: goods, services, or some asset. The debtor has received these things, and just like you would have an account receivable created, the person borrowing has account payable, right? Or note payable. So it's a symmetrical relationship. When a receivable is created, a payable is also created at the same time. Make sense? Yes? Okay. But again, in this chapter, we're talking about when we are the creditors, when our business has created a receivable or an account receivable or a note receivable. Okay, so there's Uh, kind of some major types of receivables. Again, accounts receivable. These usually are created through trade. So like when you buy inventory from your vendor, there's, or I guess when you sell inventory to your vendor, you're going to have a receivable potentially if they bought it with credit. If you provide services, uh, if you're like a, I don't know, janitorial company and you clean, your clients' bathrooms, they're going to owe you money, right? They're not maybe going to pay you cash every day, so you can have a receivable through that. And they're again usually shorter term, 30 to 60 days. And then a note receivable again is a longer term loan. It can be for various periods. It could be up to 30 years. I think the U.S. government was thinking about issuing a 100-year bond, which would have been, kind of a a liability for the government for 100 years, right? So the bondholder who had had this bond receivable uh, would have kind of had it for 100 years. Okay, they never did. This is like during COVID when interest rates were really low. Um, so they're usually, they could be 1 year to 30 years plus. And then there's other types of receivables. There's dividends receivable, interest receivable, taxes receivable. Like if you overpay your taxes, when you get a tax refund, should you be happy about that? People are really happy when they get a tax refund. But what does that actually mean? Yeah, it's your own money. You overpaid the government during the year, and they're just giving you your own money back. So during that time, until they pay you back, you actually had a tax receivable. Okay. Okay. Any questions on this? I think a lot of this should be review or any clarifications? No? Okay. Okay. So when there's a sales transaction, we've kind of seen this standard journal entry. So we have revenue that's recorded here. And then we have, in this case, we have, we saw this in chapter 5. We have a receivable and it's allocated to a certain person, a customer, this customer Brown. Okay. And of course, we would have, cost of goods sold and inventory. I'm just omitting that because for this chapter, we're not really working with that. Okay. We're just talking about these receivables. And in this one, we have another sales transaction, another receivable that's created. So what you can have in your accounting system is these subsidiary accounts. So you can see here that each customer has their own account receivable. And you can see that the balance in the total, what is called the control account, is just the sum of this debit balance and this debit balance. Does that make sense? Everyone see this? It's pretty straightforward. Okay, so now let's say we collected cash from these two customers. Their respective amounts are here, and the total amount of cash that we collected is here. So then when we look at the subsidiary accounts, we can basically take this account receivable, 4,000 goes here, this 8,000 goes here, these credits. So we have a balance here and a balance here. And you can see that the control account is reflecting the same thing in aggregate. So we have $12,000, which is, this plus this. And then the balance is also reflected, right? These two debit balances, 1,000 and 2,000, correspond to the control account balance. Okay, is this clear? I think it's pretty straightforward how you can have a sub ledger essentially. Even though this is like what's reported on your balance sheet, it's broken out into a bunch of different customers, and they're each going to have their separate accounting. Okay, but in aggregate, everything should tie together. Make sense? Okay. Okay, so this is kind of a meta question. Okay, why do companies extend credit to their customers when they sell merchandise or provide services? And basically, they're kind of going on faith that their customer is going to pay them. What is the reason? What is the cost benefit for doing this? Okay, so take a second, think about this, discuss with your neighbor, and we'll do a little brainstorming of why a business would even do this. Why not just demand whenever you provide it, goods or services to just get cash up front? Why wouldn't they just do that as a policy? And why do businesses instead extend credit? So think about that. What is the business reason for that? And we can discuss as a class. All right, who wants to share their reasoning? Anyone want to venture a guess or a confident reason why a business would do this? Yeah, Jack. Okay, but how does it do so? Okay, yeah, so good. Yeah, so some people are a little strapped for cash and they're good for it. They can pay you, but they just don't have the money right away. Okay, yeah, so it kind of it allows customers that otherwise could not make the purchase do it. Okay, what else? Any other reasons? Yeah. Okay, yeah. So maybe you don't want to handle the cash. Um, it's still though, if the customer pays you later in cash, you're still just like kind of deferring that, right? Yeah, I can get behind that somewhat. What else? Yeah. So explain that. Yeah, sure. That's possible, but it would be better if you just had the cash, right? Because then you don't have to take a loan, right? You'll have the money there. You don't have to lever that at all. But yeah, you're right. That is done in that a receivable is kind of used as collateral for a loan. But the reason why a business would do that is to get cash because they need the cash right away, right? Okay, what else? Any other ideas? Yeah. Yeah, totally, totally. That's another good reason. Yeah. So it could be that it's gonna be a source of revenue, right? Um, like automakers, they have actually like the automaking corporation, and they usually have a subsidiary financing corporation where that subsidiary provides car loans, right? Because they see that interest as a source of revenue for them. Okay, so they set it up such that they give you the car and the loan, and they're making a profit on both. So yeah, certainly that's definitely a reason. Okay, yeah. So I think we touched on the main stuff. Um, the rewards, the reason why is it stimulates a customer again who may not have the cash on hand but has the capacity to pay to buy the thing now. Okay, so kind of it's a convenience for the customer because if they need something, they can get it now and pay for it later. I guess this is like eh, this is a big trend in the consumer spending now too. Buy now, pay later. Like Klarna, there's like all these providers of financing now that allow consumers to do this. Yeah, and it's just more convenient for the customers because for a business purchaser, maybe they need to go through formal channels of approvals, and there's a whole system of approving a payment, and it's easier just to be able to consummate the transaction now and then get the payment later because the business again has a process in place for distributing funds, and it's not easy to just do it right away. So it's just a convenience too. Of course, there's risks. Um, the company has to wait for the cash. Okay, so they would prefer to have the cash because they also have their own expenses. Your business is going to have to spend cash on its own stuff, and so if you have to wait for your customer to pay you, you're going to have to figure out a way to pay your own bills, and that could be by borrowing from a bank. A lot of businesses have lines of credit like credit cards essentially available to like kind of bridge the gap between when they collect from their customers and the bill and paying their own bills. But there's interest associated with that, right? Um, a lot of credit cards though, you can get a 1 month essentially of interest-free loan, right? if you charge a bunch of stuff at the beginning of your billing cycle for your credit card, you have that entire month until the period closes, plus I think like 15 days to kind of like pay off that balance interest free. So if you're kind of savvy about credit cards, you could also use that to get kind of interest-free financing, at least for some time. But the credit card companies know that most people that charge uh, on a credit card, they're going to keep a balance, and they're going to make interest income off of you. So that's also dangerous. So if you're going to use credit cards, uh, you know, it's good to make sure that you have the ability to pay them off because they're usually very high interest. Um, And the reason why they're high interest is because of this, because many people end up not paying credit cards. So in order for it to be a profitable business, um, you have to kind of spread out the cost of those people that borrow on the credit card and never pay them back. It's unfortunately spread out across all the borrowers, and the interest rate is just higher. That's why if you have a higher credit score, your interest rate actually goes down. Uh, People with higher credit scores, you could argue, are have more capacity to pay and could potentially pay a higher interest, but they get the benefit of a lower interest. Why? Because you're a lower risk to the bank. And so the bank is willing to pay you or charge you less interest because you're a lower risk. So that's one of the ironies of society, in that people with the least capacity to pay have the highest interest rates. And that's just because they're riskier to lend to as a group. Okay, so um, in order to play the game, you should just have a high credit score. It'll be to your benefit. Okay. Uh, Related to credit scores, businesses also have kind of credit scores, you can say. There's credit ratings. And I think in chapter 12, we'll talk more about that. But as individual consumers, we have a credit score. Businesses also, the riskier businesses also have to pay more interest. And there's kind of a rating system for them. Okay. And of course, some accounts never get collected. So you could potentially provide your goods or services and never get paid for them. Okay, so that's a downside. But most businesses extend credit, and so this benefit uh, outweighs the risks for most businesses because they are discerning in who they extend credit to. They won't just give it to anybody. They'll make sure that it's a trading partner, someone that they've dealt with before and has kind of a consistent track record of paying them. So they'll try to manage this risk. Okay. Also, businesses can transfer this risk to third parties. So, for example, when you go shop at some stores will actually kind of provide you the credit. So you have like Macy's cards, Nordstrom's cards. I'd actually be curious to see if they're actually lending you the money, but it's usually a bank that will take the risk of lending money to you, and the merchant is going to just get the money. We talk about credit card fees and all that, but instead of each business lending you money to buy stuff at their store, they'll outsource that to a bank. Okay, and they'll collect the money up front. Most of it, as we saw, there's fees associated with credit cards, but then they'll let the bank deal with collecting the money from you. Um, you can also use accounts receivable as collateral for a loan. This is called factoring or pledging receivables. So basically, if you had a bunch of receivables on your balance sheet and you wanted the cash right away, you could kind of sell them or pledge them to a financial company. They will give you the cash up front. So let's say if you had like $100 of accounts receivable, they may give you $97 up front so that you have that cash. And then they'll wait to collect that remaining $3 and also just take the risk that they're not going to collect. Okay, so that $3 is their compensation for providing that financing. Um, okay, yeah, and obviously these businesses, banks, financial services companies, that's their whole business. Uh, they're their whole business model is extending credit. Okay, so some businesses it's kind of like a side hustle, right? Or maybe it's just a way for them to generate sales. But for some businesses, it is their main business to give loans, right? So they're gonna obviously make that a big part of like what they do, and managing the risk and all that is like the main a main operational kind of activity for the business. Okay, any questions on this? Yeah. Okay. No, you don't. Yeah. There are some transactions where you actually sell the receivables to like a special entity that's set up for it. Sometimes it'll just be a loan agreement, and the bank is going to just in the loan, like in the contract, state that they have recourse to those assets, even though there's no transfer. So yeah, it's more of a legal complication of like how the lender will have recourse to those assets. But yeah, it's functionally the same thing. Okay. Okay, so I would say this slide is maybe the most important slide or it summarizes the main topic in this chapter, which is how to deal with bad debt. Okay, how to deal with receivables that are not going to be collectible. Okay, so we'll talk about the different tree, like how this tree branches off, but I would pay special attention to this. Okay, so um, when receivables go bad, what do we do about that? Um, well, there needs to be a couple of things. For one, the account receivable asset needs to go down. And remember, you initially recorded some sales revenue, right? You had accounts receivable, sales revenue. So if you can't collect your accounts receivable, we agree that this has to kind of go away. But we also have to do something about this part of it, because our income statement is also affected by this account receivable being uncollectible. So we have to fix the balance sheet and we have to fix the income statement, both. Okay, because uh, when we can't collect, it's affected the original transaction affected both of those financial statements. So now we have to do something to correct both of them, not just one of them. We can't just reduce accounts receivable. We also have to figure out a way to fix the profitability of our business, because we kind of overstated revenue if we weren't able to collect this account receivable. So uh, the way we're going to do it is not actually reduce revenue. We're going to take an expense. Okay. So the expense is going to be fixed, or sorry, the income statement is going to be fixed by taking an expense to offset that sales revenue. And we're also going to do something with the account receivable. Okay. So there's two methods. Uh, the first one, the simpler one, is the direct write-off method. Basically, what you're going to do is you're going to just assume you're going to collect all your receivables until there's some obvious thing that happens where it's uncollectible. Okay. So that customer says, hey, I'm not going to pay you, whatever. There's a definitive moment where you're like, I can't collect that receivable. At that time, you're going to then write off that account receivable. Okay. You're going to, as the name implies, directly write it off. Okay. So you're going to record the bad debt expense after you realize that the receivable is uncollectible. So while this is simple, it violates the matching principle. Why is this? Why is this method not in line with the matching principle? Does anyone have any idea? What is the matching principle? I guess that's a more basic question. Yeah, Margarita. Exactly. Yes. Exactly. Yes. So the problem with this direct write-off method is that when we actually realize that the receivable is uncollectible, it's going to definitely be in a different period, or I mean, it's most likely going to be in a different accounting period than when we recorded the revenue. Okay, so we're going to have a mismatch between the bad debt expense and the revenue that was recorded. Okay, so though this is simpler because we don't have to do any estimating, we just wait until we actually have a receivable that's uncollectible and then deal with it. It's gonna not be in line with this matching principle. We're gonna have the risk of having overstated our profitability in a previous period. Maybe we generated a bunch of sales by just extending credit to customers who are like not trustworthy. Okay, so in that period, our revenue would have been really high, but then only later in a future period, we would realize that all those customers are not going to pay us. Okay, and we would have to take a big expense in that later different accounting period. Okay, so we want to avoid doing that. Okay, but for small businesses, in certain contexts, maybe the direct write-off method it's just simpler. Okay, we don't have to do any estimating. That's really the big advantage of it. Okay, so now the allowance method, which is kind of the method as that we need to do, like we need to implement for GAAP. We're gonna basically do an adjusting entry at the end of our period, and we're gonna estimate how much of our accounts receivable we're not gonna collect. Okay, and it's not gonna be accurate because it's an estimate. We're gonna be using assumptions. We can't predict the future exactly, but we're gonna make an educated guess um, as to how much of our account receivable is going to not be collectible and take the expense in the same period. Okay, so this does adhere to the matching principle, but it's just less accurate because we again don't know exactly how much of that account receivable at the end of the year we're not going to be able to collect in the upcoming year. Okay, we're going to have to estimate that. Okay, so how do we estimate that? Now we have these three different methods to do it. Okay, so these three methods is how we're gonna figure out. Let's say we had, whatever accounts receivable at the end of the year was $500, or 500,000, I guess. How much of this should we assume is uncollectible, right? What is the proper what is a reasonable way to estimate how much we're not going to collect? So there's, again, these methods, the percentage of sales method, the percentage of receivables, and the aging of receivables. And you can kind of, it could be argued that these are in increasing levels of sophistication. This percentage of sales method is, as we're going to see, I think the least sophisticated. Percentage of receivables is a little more reasonable. And then aging of receivables is a much more granular way of doing it. Okay. Um, but they're all, again, getting to this uh, idea of how much bad debt expense should we take as an adjusting entry. Okay. Um, and so these are three different estimating methodologies. They're all allowance method because the allowance method is basically having to take an adjusting entry in the first place. But how much bad debt expense should we take? That's going to be determined by which of these three methods we use. Is that clear? Make sense? Okay. Okay, so let's look at this example. On August 9th, your company determines that it will not be able to collect $200 from this customer. Um, this is the direct write-off. Okay, this is direct write-off. So we're only going to do something at this time where like Dan King is not going to pay us. Okay, we know specifically which account receivable we're not going to collect and when. Okay, Dan King called us up and he's like, I'm going out of business or whatever. So at that time, we know exactly who is paying us, who is not going to pay us, and what the amount is. Okay, so now we can directly write it off. So what we do is we'll take a bad debt expense of $200 and we'll reduce this guy's account receivable because before we had account receivable King we were sitting happy thinking we're going to collect 200 bucks from this guy. We had an asset worth $200, but now this guy calls us up and we're like, we're not going to collect it. So this asset needs to go away. It needs to go to zero. So we need to credit this 200. And it's not like he's paying us the cash. Remember, if he paid us the cash, we would do debit cash 200, credit account receivable. But he's not paying us. So instead, we're going to take this bad debt expense. Okay, makes sense? Direct write-off, why it's so simple. We know exactly how much and we know exactly who is not paying us so that we can directly go to our accounts and change them. Okay, we know exactly what to do. Okay. And again, even though we know on August 9th that we're writing this off, it could have been that this sale to King happened 2 years ago or whatever. It could have happened a long time ago in a different accounting period. So this expense is going to be mismatched with the revenue. Okay, so that's the whole problem with this direct write-off method. Okay, so I think we've talked about this. What are the ways we could manipulate our financial statements? Again, a company could just generate a bunch of revenue by, having some customer that is like is not credit worthy, right? You could argue, I don't know, these AI companies are doing this now. There's some rumors that like what's it called? OpenAI is going to go bankrupt. Okay, there's a ton of receivables that are probably outstanding where OpenAI is the one that owes money. Okay, so if they go bankrupt, all those receivables are going to go bad. Okay, so but in the interim, these businesses have booked a bunch of revenue off of OpenAI. I think a lot of the chip makers, Nvidia said OpenAI is going to buy $5 billion of chips, and they have a receivable for that. Okay, so they've already booked that revenue, and their stock has gone up accordingly. But if OpenAI goes out of business, that $5 billion of account receivable is going to go away, and they're going to have to take a loss for that. Okay, so this happens. Okay, this is not like a fake kind of hypothetical. This type of stuff does happen. Okay, um, now this is kind of like a special case scenario where let's say we wrote it off. We again did this write off. So King's kind of financial statement or our account for King looks like this. It's zero. But let's say he comes back and he's like, "Hey, actually, I can pay you. Okay, I found the money, whatever." So what we're gonna do is kind of first reverse what we did. Okay, so you can see here we're restating the account receivable. So we go from here. We're gonna debit this again, 200, and we're gonna credit this expense account. We're just undoing it essentially. Okay. Now there could be a problem in that this happens in a different accounting period than the expense, and we end up with a bad debt expense credit balance. So we'd have to fix that somehow. Um, Maybe make that other income. We'd have to make this actually bad debt revenue or something. We'd have to maybe fix it if it's in different accounting periods. Because remember, we can't have a credit balance in an expense. Okay, that would be kind of that'd be weird. We'd have to do something about that. But let's just assume that it's in the same accounting period. We're reinstating the account receivable. The bad debt used to be 200, right? From this, we had this debit, but now we're crediting it. So now we have zero bad debt expense. Sorry, bad debt expense. So we've kind of undid that entry, and now we just collect the cash. So now we get rid of this. So now this still goes to zero, but now we've debited cash. Okay, so this again is in the case where you first wrote off an account receivable, and then the person comes back to you and is like, "No, I can pay you." This is what you'd have to do to kind of fix that. Okay, any questions on this? No? Okay. Okay, so again, the allowance method, I think we've already talked about a lot of this. The allowance method, is going to be adhering to the matching principle. That's the whole reason why we're doing it. We don't know ahead of time who's not going to pay us and how much. Okay, so we're going to have some generic way to deal with this. Okay, because we can't say in the last example we knew that guy Dan King is not paying us, but when we are at the end of the year, we have a bunch of accounts receivable with a bunch of different customers. We don't know ahead of time who's going to not pay us. Okay, so essentially what we're going to do is we're going to set up a little piggy bank account, and then as actual customers stop paying us, we kind of draw down that piggy bank. Okay, so that's kind of what we're going to be implementing. Okay, so again, yeah, the problem is we don't know which customers and how much we're gonna not be able to collect. So the solution is we set up this piggy bank. It's called Allowance for Bad Debts. Okay, that's the name of our piggy bank account. That's gonna be kind of where we're gonna set up this fund for all the receivables that we're estimating we're not gonna collect. It's a contra account. It's paired with accounts receivable. And then in the future periods when we actually have accounts receivable go bad, we're going to reduce that piggy bank. Okay, and I'll show you how that's done with the journal entries in a second. But just think about the concept of a piggy bank that we're setting up at the end of the period. It's meant for drawing down when we actually have accounts receivable to set up. We've already taken the expense. We've already factored it in to the financial statements for that previous period. And then as things go bad, we can then just draw down the piggy bank instead of having to take an expense every time. Okay, so we're basically taking the expense up front, setting up the piggy bank, and then drawing that down. Okay. Um, there's a problem with this system. The piggy bank is not going to be set up exactly for how much we actually have to write off. Because again, it's based on an estimate. The piggy bank is set up based on a estimating methodology, and it's not going to be correct. We're going to either overestimate or underestimate. Okay, so at some point we're going to have to true it up. We're going to have to true up how much we actually expensed as an estimate with what actually happened. But we're not going to be able to do that until the future kind of plays out. Okay, so the system again has its significant drawback, and a company can also play a lot of games with these estimates. I think I mentioned, another estimate that is used is for warranties, where you don't know exactly how many people are going to come back and use a warranty. So Tesla was like notorious for basically selling way more cars, but they didn't really increase their estimate for warranties. Okay, so that's one way that they were they underestimating or overestimating how much warranty expense they're going to have in that case? Underestimating, right? So they're going to later have to take a much bigger expense. Okay, but they did that to boost their net income in the short term, because if you're underestimating the warranty expense, it's going to make your net income higher, right? So companies can do this a lot. Insurance companies, they're doing a lot of estimations on how many losses they're going to have, like in a given year, and so they can also really play games with these estimates. Okay, so the estimates are not perfect, and a company can really game the system to their advantage, or to like deceive in a deceptive way if they wanted to. Um, okay, so this is kind of how it works. At the end of the year, our accounting department estimates that $1,000 of accounts receivable should be expensed as bad debt. And again, how this $1,000 came about, we're going to talk about. There's those three methods, right? But for now, just assume that this $1,000 is there. Okay. So what you'll do as an adjusting entry, just like every adjusting entry, it's at the end of the period. You're going to take this expense, $1,000, and you're going to set up this piggy bank called Allowance for Bad Debt. Okay, this is a contra asset account. It's paired together with the accounts receivable. Okay, so now this bad debt expense is going to appear in the income statement for this same period as the revenue. Okay, so let's just make sure we're clear about this. So on the balance sheet, let's say we had $15,000 of account receivable. We just set up this allowance for bad debt of 1,000. Okay, this is our piggy bank. This is the gross amount of account receivable, but we're not going to be able to collect all of it because we're estimating that some of these people are not going to pay us, right? So what we're going to do on our balance sheet is only record the net value because we have this debit balance and we have this piggy bank set up for those $1,000 worth of account receivable. We don't know exactly who is not going to pay us, but we've already kind of accounted for it up front. So on our balance sheet, we're only going to report 14,000 because really that's what we think we're actually going to collect, right? Though we have 15,000 gross, we're already presupposing that 1,000 is going to go bad and we're not going to collect it. So on our balance sheet, we want to show only what we think it's actually worth. It's not worth 15 because we know we're not going to collect all of that. So we're going to report this net balance, which is the gross less this contra credit balance. Does it make sense? Yeah.
So you stop allowance for bad debt at the beginning of the year, or
It's going to roll forward. This is a permanent account. So
no, not that question. How the account receivable constantly changes, right?
correct.
So at which moment, using balance sheet method, we're gonna create allowance for bad debt $1,000 if we have 15,000 is in January.
So this is all reported at the end of the year, right? So this is all for the financial statements ending December 31st. You're right. In the next accounting period, accounts receivable is going to change. We're going to have actual write-offs that happen. And at the end of that period, it depends on how often you do your adjusting entries. But yeah, if you did adjusting entries every month, you would have an estimate every month, and you do an adjusting entry every month to update this.
So this happens at the end of any.
You're going to see when we actually write off, like when an account receivable actually goes bad, that account, this allowance for bad debt will be affected. So
It's already there to be affected.
yes, yes.
That means it has to be assigned at the beginning of the period.
Yeah, you can assume that this is the first year of the business if you wanted to. But yeah, this allowance for bad debt is going to be a running balance. So maybe it started at zero. It could start at zero. It's possible. Why don't you see the next how it works out, and then let's see if your question is answered.
There's this in the book, so
Okay. Okay, let's see. Let's keep going. I'll talk through it, and if you're still confused, we can talk about it. Okay, so now we have this piggy bank set up. We have at the end of the year, this is what we're going to report for account receivable. And on the income statement, we're going to have this $1,000 debit. And so the income statement is going to look something like this. Sales revenue 15,000, cost of goods sold. And this other expense, this is where this is coming from. So this net income is assuming, because this 15,000 was from credit sales, that's where kind of this came from. But this 1,000 is already kind of assuming that 15,000, some of it is going to be like not correct, okay? Or like it's not going to materialize. So this net income is now cleaner, right? We now have accounted for some of those credit sales not being collectible. Does everyone agree with that? Yeah? Okay. Okay, so now let's do the next thing. Okay, so now we have these 14,000, this 15,000 in accounts receivable. Now we're like, someone is not going to pay us. This customer, Wilson, is not paying us $500. So think about, what is a journal entry now? What should we do? See if you can figure this out yourself. And then think about what happens to the account receivable. Assume this is like the first transaction of the year. Okay, there's been no credit sales. Our balances are still this, it's not realistic, but just assume that this is our balance for account receivable. This is our allowance for bad debt. And of course, since it's the new year, this goes to zero. Okay, this is a temporary account. Okay, so think about what the journal entry should be. And again, we're using the allowance method now. Does anyone have any ideas? Are we going to take bad debt expense? How about that? Let's start with that question. Who thinks that bad debt expense is going to be part of this transaction? Raise your hand if you think is yes. Raise your hand if you think no. Okay, good. Yes. We're not going to take bad debt expense. We already did. We already, in this instance, already assumed that some of these account receivable are going to go bad. We already took the expense. So when it actually happens, we don't have to take that expense again. We pre-took that expense. Okay, so now we kind of have this piggy bank of $1,000 that we can take the actual bad debt when it actually happens. We can use this piggy bank. Okay, so what we'll do is we're basically gonna have to reduce the account receivable. Okay, so let's just look at it here. So we're gonna debit allowance for bad debt, and we're gonna credit account receivable Wilson. Okay, so what that's gonna do to our account balances is we had this account receivable, which included all of our subsidiary accounts, right? Wilson was in here. Wilson, Davis, whatever. You had all these different people. They all constituted this. Now we're getting rid of Wilson. So we're going to credit uh, account receivable 500, and we're going to debit our piggy bank allowance for bad debt 500. So this is going to get reduced. This is also going to get reduced. Okay. The net has not been changed, right? We have a 14,500 debit balance here and a $500 credit balance. The net amount is unchanged. Now, does that make sense? What do you think? Anyone think that it makes sense? Yeah, it makes sense, right? Because again, back at this moment when we took the adjusting entry, we knew that some of this was going to go bad, right? We already reduced it here. So when things actually play out the way we thought, it's like not unexpected. It's already baked into here. Okay. So yes, this makes sense because we just drew down on this piggy bank. We already set up losses of $1,000. So now we're actually using that piggy bank. Okay. So of course this could be a problem. Like let's say we had another write-off for, let's say there's another write-off for $1,000. Okay, so now we would have to credit 1,000 again here, some other customer, and we'd have $1,000 here. So now this is going to be 13,500, and this is actually going to turn into a debit balance 500. Okay, so this is wrong. We can't have this allowance for bad debt contra account ever go into debit, because now what is this? It's still going to be 14,000, right? Now we have debit balance, right? But that's wrong because we've actually overspent our piggy bank. So we'll have to take another, we'll have to do something. We'll have to fix that. Okay, so maybe this is your question. No? Okay. Is your question, what is your question? Or what logistics?
Where December 1st, we analyzed the period, like closed in allowance account, allowance for bad debt account, $1,000. But that is not what was calculated on the
For that,
year.
you mean at the beginning of the year? That same year? Or the,
I mean,
well, okay, so how about this? Maybe this will clarify.
it makes sense.
Yeah.
It's a date. It's like when that thing happens, like at what point.
Okay. So how about this? Let's say this was the only write-off that happened this year, okay? And this $500 write-off. Okay, so now these are our balances at the end of the year, right? So now we're going to do another estimate. We're going to say of this 14,500, maybe we expect $500 of that to be uncollectible.
Again at the end of
Yeah, again of the year. Uh, and actually, we wouldn't have to do any. If we thought that of this 14,500, 500 is uncollectible, we already have the piggy bank set up here. Okay. What if we thought that $1,000 is going to be uncollectible?
Then we're gonna do an adjustment.
Then we're going to have to do an adjustment. We're going to have to make 500 here and take bad debt expense 500
So
as an adjusting entry.
the only way I can see it's us, everything has to happen, write-offs, any account has to happen on December 3rd.
No, because this write-off happened on a different day. This happened whenever the person, but we're going to true up. We're going to add to this allowance for bad debt only at the end of the year. We're going to see what the balance is at the end of the year. And then we're going to do an adjusting entry based on that ending balance.
I can come to you after the class.
Okay.
You're right.
Okay. Maybe when you see the methods too, it'll make a little more sense. Because like some of the methods, you have a balance. Like you're going to assume that I need whatever $1,300 here, right? I'm going to assume that this is the balance I need in allowance for bad debt based on my estimates. So what would my adjusting entry be? To get, if this is my ending balance unadjusted, I want this to be my adjusted balance. What do I need to do? Uh,
Plus, no,
700, right? Oh, wait, 800. You need 800 credit, right?
yes.
And so that would mean that I would take a bad debt expense 800, credit allowance for bad debt 800. And then that would give me this piggy bank at the end of the year. And then I would have some other write-offs. Maybe I would have $1,500 of write-offs. And then I just keep updating this allowance for bad debt based on what the ending balance was. Okay, so maybe you think about it. Yeah. Well, well, it's going to be a running balance. So you're going to have like, yeah, the first year your business starts is going to be zero. At the end of the year, you'll set it up, um, and then it'll just keep getting updated. Okay. So yeah, I just assumed like maybe it was zero. This was the year one adjustment. This was the year one ending balance unadjusted, right? Because we only had this one write-off. This is what our year two adjusted balance needs to be. So this would have been our end of year one adjusting entry. So you just keep doing that every year. You just, based on what actually happened and what the beginning balance was, you would update it. Okay. Okay, so now where does the bad debt expense estimate come from? So again, we need to figure out what that amount was. We were just told it was $1,000 here, right? We just, again, came up with this number, but where does it come from? There's three different ways that we can estimate it: the percentage of sales, percent of receivables, and aging of receivables. What you're basically going to do is use historical information from your company, from your industry, and see how the economy is doing. There's probably some accountant. Their whole job is to do these estimates, okay? Because this is a involved process, but it's basically going to be based on past experience, um, who your current customers are. There's going to be some credit analysis, and you're going to come up with some estimate of how much total you're going to not be able to collect based on what your accounts receivable are at that moment. Okay, um, and you're going to either have that as some percentage of your sales, some percentage of the ending balance of account receivable, or in this aging of receivables is a little more complicated. Okay, so we'll look at that in a second. But let's talk about these other two. So percentage of sales, basically, you're going to take some percentage of how much revenue you generated, and that percentage is going to be based on what I talked about: historical analysis, trend analysis, factoring in the economic factors. You're going to come up with some percentage, okay? And then you're going to apply that percentage to how much you generated in sales. And that's going to be how much bad debt expense you're going to take. So this is called an income statement approach, because you're just, you don't care about your ending account receivable balance. You actually just look at how much sales you generated. And it's going to be either, it's going to state whether it's a percentage of all sales or just credit sales. Okay, so it's going to be like 5%. 5% of what? 5%, it's going to state, is it 5% of credit sales? Then you'll see how much you generate in credit sales and multiply that by 5%. If it's 5% of all sales, you'll multiply your total revenue by 5% to get the bad debt expense. So just make sure that you know what the percent is applied to. You have to read carefully and make sure you're clear on what revenue it's talking about, because it could be, if you have $1 million in revenue, maybe 700K of that was cash sales and only 300K was credit sales. And so if it was 5% of credit sales, you'd only multiply 5% by the 300,000, not by the full million. Okay. But if it was 5% of all sales, you multiply it by this million. Okay. Everyone clear about that? The difference between credit sales and total sales? Okay. Okay. So the other problem with this is that it doesn't self-correct. Okay. We're going to see with the other two methods, they will get trued up every period. Okay. This method, you can keep having structural errors until you're going to hit a point where it's like your allowance for bad debt is basically a debit balance. That's when you've screwed up beyond being correctable. Okay, so again, your allowance for bad debt, if it ever became, it should always be a credit balance because it's a contra account. So if you keep making structural mistakes and it eventually becomes a debit balance, your accounting for bad debts cannot continue. You have to at least get it to zero. Okay, you cannot allow allowance for bad debt to be a debit balance. It's incoherent. It becomes like it doesn't become, it's invalid if it's a debit balance. Okay, so at that point, if you're using percentage of sales, you'll have to make probably a large bad debt expense correcting entry. Okay, to not only make up for all the previous periods you've been underestimating, but to also get a credit balance back into bad debt expense. So that's what a lot of businesses will do. They'll underestimate the allowance for this kind of stuff, and then some new CEO's taken over, and it's like not your problem anymore, and then they'll have to take a really big adjusting entry and a big expense, much bigger than they would have had to if they had just been doing it correctly or honestly up to that point. So this is very common in like kind of corporate accounting too, to pass the buck to the next CEO or the next managers. Okay, because that boosts the profit in the period that you're CEO. If you can boost the profit and have your stock options worth more, you're going to do that, and then screw the other guy. It's the other guy's problem. Okay, and this is unfortunately very common. Okay, so in this example, past experience suggests that 0.5% of credit sales, okay, so this is again very clearly written here, will be uncollectible, and the credit sales are $60,000. So the amount of bad debt expense is going to be this 60,000 times this 0.5%, and this gives us how much bad debt expense to take. Okay, so it's a very simple uh, kind of method. Uh, the hard part is coming up with this. But again, this class, you're just going to be told that this is a whole large analysis to come up with this 0.5%. Like, where did that come from? That's the next question. And that is like, much more complicated. You have to see the history of the company, all their collectibles. They'll look back in time for the last 5 years and seeing how much they've kind of had as bad debt expense. And they're going to come up with this 0.5 and assume that's going to be the projected forward-looking bad debt expense. Okay, so this 0.5% there's a lot built into that, but we're not going to really talk about that. It's a much more complicated analysis. Okay, but for our purposes, we're told this 0.5%. We multiply it by our credit sales, and then we do this adjusting entry. Okay, so there's going to be some existing balance, unless it's the first year of our business. So allowance for bad debt. Maybe we had, $1,000 as the unadjusted balance at the end of the year. Now we have this adjusting entry. We're going to add another 300 to it. So now we have 1,300. So now our piggy bank is set up for the next period. Okay. And then of course we'll have some write-offs that happen. This piggy bank will get drawn down. We'll have some new at the end of that year. Maybe we had, I don't know, 1,100 in write-offs that happened during the year at various times. So the ending balance is now $200. And then we'll have another adjusting entry that happens at the end of that year, and it'll just keep rolling down. Okay. But again, as I mentioned, like there's no self-correcting thing, because this $300 is not based on the account receivables. It's based on the sales that happen in that period. So if we're overestimating, this thing can keep growing. Okay, so let's do a slightly different example here. Um, if this, instead of 1,100, was only 100, okay, then this would be 1,200 instead. And then maybe we have another $500 adjusting entry, and it's 1,700 now. So you can see it's growing. It started at 1,000, it went to 300, 1,300, it went to 1,700 here, and it can keep growing like this. Okay. In this case, we're overestimating how much bad debt expense we have. Okay. And so this method is not correcting that. It can just grow indefinitely. Okay. Um, so that's one big flaw of this method. Okay. It's not targeting a bad debt, like a bad debt piggy bank. The piggy bank is like a secondary effect of the estimate. Okay. So you're going to see in the next methods that actually, it's going to target how much the piggy bank should be every period. That's a maybe more accurate way. But for now, let's just see again, to clarify. So we have this as our starting balance. We have, these two write-offs here at random times in the year. Our unadjusted balance at the end of the year is this. We then have the adjusting entry, right? We have this adjusting entry here that's adding some balance to our piggy bank. And this is our adjusted balance at the end of the year. And then, of course, we'll have some more write-offs. We'll have some new balance. We'll do another adjusting entry, and it'll just keep rolling. Okay, makes sense? Any questions on this method? Okay, so um, let's change one thing though, okay? Um, if this November 22nd write-off was 1,300, if we change this to 1,300, what is this going to be now? What is the unadjusted balance? How much? Actually, no, 1,300 is, I'm trying to get this to be 0, okay? So we would have had to make this 1,000. So I need to change this. This is 1,000. This was 1,000. This is going to be 0. Everyone agree? This adjusting entry, as I said, it doesn't matter. It didn't really care about this if it was 800 or 1,000. This $300 was based, again, on this calculation, based on our sales from the period. Okay, so now uh, this would be 0, this would be 300, and this would just be 300. Okay, so our piggy bank is smaller now, right? In the next period, maybe it's going to be not enough to cover all the write downs. Okay, so now if this was even larger, this was even larger. Let's say it was 1,600. This is now 2,100, 15. So this is a $600 uh, debit balance. This adjusting entry is unchanged. And so we're going to end up with the invalid kind of allowance for bad debt. We would have a $300 credit balance, or sorry, debit balance. So this would be wrong. We'd have to do some large adjusting entry here. We could not just leave this. We'd have to fix this. Okay, so this is, again, I'm trying to illustrate the drawback of this uh, percentage of sales method. It's not always going to give you like if you have some structural problems with your estimating, it's gonna at some point blow up. Okay, which is what happened in this case. If I had basically too much write down for how much I had in the piggy bank. Okay. Okay. All right. So let's do a practice problem. Why don't we take a break for a couple minutes, and then we're gonna do 8-36B, where you have to use this method. Okay, so here's the setup for this question. Okay, it's giving you your starting balances for your period. It's giving you some information on what happened during the period, and then you're going to be asked to do a adjusting entry um, using this percentage of sales method. Um, and so, if I were you, I would start by filling in these T accounts, for accounts receivable, allowance for bad debt expense as of the beginning of the year, and then factoring in what happened during the year. And then that will help you set up kind of what to do for the adjusting entry. Okay, so try to figure this out on your own, and then we'll just do it together as a class. Okay, so let's fill in this information at the top. They have a $180,000 debit balance in accounts receivable. Okay, so I'm going to put that in here. $7,200 credit balance in allowance for bad debt. So that credit balance I'm putting in. Okay, and now we have the following transactions. Okay, so this is kind of like starting balances, right, for the period. Um, Sales on account, 560,000. So that means that this account receivable, we're going to add to it 560,000. Because again, the journal entry there would have been basically in aggregate, we would have seen something like this. We would have seen something like uh, accounts receivable, 560,000. I'm just doing it all in one shot. Of course, these would have been spread out over a number of different sales transactions, but in general, they would have followed this same pattern, right? Sales revenue, credit, account receivable, debit. Does everyone agree with that? These credit sales? Yeah? Okay. So that's why I'm going to debit account receivable, 560,000. And they collected 598,000. So remember, they started with 180,000, they added 560,000 throughout the period, And throughout the period, they're going to collect 598,000. Okay, so that's going to be of the form cash, 598,000, accounts receivable, 598,000. And we don't exactly know how this is split because remember, some of this is going to come from the starting balance and some of this is going to come from that 560, right? So this was the total amount of collectible, and this is going to be mixed. Some of, I'd say most of it is probably from here, and some of it is going to be collected from this. But we don't know that, and that doesn't really matter for our purposes. Okay, but just remember, this is kind of the total of accounts receivable, the universe of accounts receivable, and we collected this much of it. So what is this? This is um, 4, 6, 740K. This is 740K in total accounts receivable. We collected almost 600,000. Okay, so is everyone good with this? Everyone following where these numbers are coming from? If you're not following, raise your hand and ask. I can clarify again. Okay, okay. So then we also wrote off some uncollectible receivables of 9,000. Okay, so we just talked about what that journal entry is in the allowance method. So what is the journal entry? What would we have done for these uncollectible receivables? What's the form of that journal entry? Is bad debt expense going to be involved in the allowance method when we actually write off accounts receivable? No. What are the accounts involved? Okay. So allowance for bad debt is going to be debited. And then we're going to credit accounts receivable. I think it was 9,000. So in order to do this problem, you need to have known the form of these journal entries, right? It's just giving you the information. You need to understand the meta of what that means in terms of the journal entry that's related, okay? So in this case, we're going to have $9,000 debit to allowance for bad debt and a credit to accounts receivable. So 9,000 and then 9,000. Okay, so now we have some balances. So the balance for accounts receivable is 133,000 debit. Okay, we have an unadjusted balance in account allowance for bad debt, which is a debit balance. This is, we can't have this. This is the unadjusted balance. So after the adjusting balance, after the adjusting entry, it has to become a credit balance. Okay, if it's a debit balance still, even after the adjusting entry, there's a problem. Okay, so we have these balances, and now we're going to do the adjusting entry. Okay, so why don't I pause here? Make sure you know how to do this. It's telling you the bad debt expense is estimated at 1% of credit sales. So it's giving you that percentage of sales. And since we're using percentage of sales method, um, actually, okay, it's asking for a couple of different things. First, it's asking to use the direct write-off method for account for uncollectible. Okay, why don't we skip number 2 for now? Okay, it's asking us to use this information to do direct write-off. Just skip that for now, and just do the journal entry for. Just finish this part. Just finish number 1. What is the adjusting entry? Let's just stick to that for now, and then we'll maybe do number 2 together. Okay, so how much should I take as my adjusting entry for bad debt? This is again going to be dated on September 30th. This is an adjusting entry. What do you guys think? Anyone have any opinions on what the adjusting entry is? Yeah, Mohammed. Okay. And how did you get 5,600? Okay, yeah, that sounds exactly right. So we're told that the bad debt expense is estimated at 1% of credit sales. We're told that the sales on account, which is a different way of saying credit sales, is 560,000. So do 560,000 times 1%, get 5,600. Okay, so now let's look at our T accounts. So now this is our unadjusted balance. Now we're gonna have a credit to allowance for bad debt. So this is our adjusting entry. So now we're happy in that our unadjusted balance, or sorry, our adjusted balance is a credit balance. So we're happy about that. This is valid. But the problem is that since we had underestimated in the previous period, our piggy bank has been kind of diminished for that mistake, right? Because we're saying just based on this month's sales, we expect $5,600 to be bad debt, but our piggy bank only has $3,800 in it because we didn't do a good job estimating in the past, right? We had this debit balance. So this mistake of underestimating in the previous period, we're kind of paying for it somewhat here. Okay, we're kind of like we don't have a sufficient piggy bank to cover what we think will happen just from this month's sales. Does everyone see this structural problem? Like this is unsustainable because even if we did a good job in this month, the next month, this systemic problem will keep perpetuating. Okay. Um, or if this 1% is too low, then next month this adjusting entry will keep getting closer to zero. Once it goes into debit territory, even after the adjustment, then there's a problem and we'll have to fix it. Right now, we can keep going like this. This is still like kind of valid. But once this adjusted balance, even after this adjustment, if this is still a debit balance, then there's a problem and we'd have to do something about it. And that would probably mean taking, instead of a $5,600 adjustment based on this month's sales, or it'd have to take like a $10,000 adjustment just to make up for all the previous period's mistakes. Okay. And so that would make our net income for this period even lower, right? We'd have to, in this period, take a much larger hit to our profit because of all the previous kind of uh, misestimates. Okay, does that make sense? Uh, in the real world, the opposite can also happen, where you take more expenses than you need to in a period, where maybe you're making a lot of profit, and so you take overestimates as a piggy bank that you can release in the future when you have not as good performance in your business. So you can boost your net income by taking more of a bad debt expense or a similar kind of expense in a period where you're doing really well, and then release that later. Okay, and this is a method of smoothing your earnings. Okay, and this is also commonly done. So these estimates, I don't know if you guys remember from the first week of class, we heard that Warren Buffett clip where he's like, I could tell the type of people running the business just from looking at the financial statements, and it's largely probably from this kind of stuff, where he's seeing, do they do this game of taking large losses every so often for misestimating, or do they release a bunch of losses that they've taken as a way to boost income? And if they've done a good job, uh, you know, releasing is better than taking the large loss, right? There's one insurance company I personally invest in where they never have or rarely ever have a negative revision to their loss estimating. Okay, they're very conservative about how much they estimate they're going to have to pay out in their insurance claims. They typically every year they release more than they estimated because they never want to be wrong. They never want to uh, take a larger expense in a future period for doing a bad job of estimating this. They'd rather release and boost their earnings. Okay. So, and I can also tell they're a very honest company. You can look back in the last 20 years of their insurance reporting, like how they've accounted for their insurance claims, and they've been very consistent about that. So I know that they're not doing this stuff to smooth their earnings. Okay. So, this meta understanding of estimating and how expenses are taken and then can be released over time if you've overestimated. It's important. It actually does matter. It's useful information. And this system of accounting, how it works in various insurance, warranty claims, bad debt expense, it's all using similar methodologies. So if you understand this, you can kind of apply it to other areas of accounting. Okay. Okay. So what would change if we did direct write-off method? Okay, so for one, this whole account would not exist. Okay, direct write-off method does not use allowance for bad debt, right? We only just directly write off account receivable. Okay, so let's just kind of redo this. So again, let's just finish this off. So in this case, we would have 5,600 here. Sorry, 5,600 here, debit. This is credited, and then all this other stuff, this and this are related. Okay, so now let's see what would change if we had um, direct write-off method. Okay, so oops. So this whole thing won't exist. Okay, we wouldn't deal with anything related to allowance for bad debt. So instead of uh, this write-off for uncollectible receivables, if you saw here, credited, uh, we debited allowance for bad debt and we credited account receivable. Okay, what we're going to do instead is just directly write off account receivable. So this credit to account receivable is going to be the same, but we're going to just directly debit bad debt expense. That's really the change. Okay, um, because again, you're not using this intermediary piggy bank account of allowance for bad debt. You'll just directly write off the bad debt expense, and then there would be no adjusting entry. We would have no adjusting entry for direct write off method. Okay, does it make sense? Okay. Okay. Let's just start talking about the next method because it's uh, similar in some sense, but also has a very, I think, more coherent and common sense kind of method of dealing with this bad debt expense. So the percentage of receivables method, um, instead of using like credit sales or total sales as the basis of the estimate, which doesn't really make sense because like for credit sales, even if you use credit sales where there is an account receivable collected, maybe you collected most of that in the same period, right? Maybe it was like a 10-day kind of payback period. Your typical customer pays you back in 10 days. So a lot of those credit sales you've already collected in the period. What the percentage of receivables method is doing instead is looking at the end of the period, what is your actual balance of accounts receivable, right? Forget about how the revenues and the sales and all that, but how much account receivable do you actually have as of the end of the period? And then based on that, what percentage of that are you going to estimate is going to go bad? Okay, so this is called a balance sheet method because again, you're not looking at your sales or anything. You're looking at just the hard number of what is your outstanding account receivable at the end of the period. Okay, it doesn't matter if the account receivable is from uh, 60 days ago or account receivable from 1 day ago, you're going to just look at what is the outstanding account receivable balance and then apply a percentage to that. Okay, so that seems a little more reasonable because, again, a lot of the credit sales that you generated in a period, you've probably already collected. So it seems more reasonable to me to just look at the end of the period, what are your account receivable balance? Okay, some percentage of that is going to be uncollectible. Okay, so we're going to basically, again, the percentage that you come up with, that is a whole kind of topic in itself, where that percentage comes from. But what we're going to basically do is, instead of just taking a percentage of the sales and like using that as the bad debt expense, you're going to figure out what the target balance should be for your bad debt expense account. So you're basically like, okay, have certain amount of account receivable at the end of the period. I'm going to say 5% of that is uncollectible based on my estimates. So I want my piggy bank to be 5%, right? I know exactly how much I want in my piggy bank, right? Instead of calculating the amount of the adjusting entry, I'm first starting with how much my piggy bank should be, right? So this is different than what we just did, because again, in the last method, we just took a percentage, multiplied it by the amount of credit sales, and this was the amount of the adjusting entry, right? It doesn't matter what net balance that's going to give to me for allowance for bad debt. This is just the amount I'm going to take as the adjusting entry for bad debt expense. Now what I'm doing is I'm saying no. Like, see, in this case, we just calculated this. This was kind of a byproduct of both this adjusting entry and all the stuff that happened in the past, right? Now what we're doing is we're going to start by saying what this should be and then backing into this adjusting entry amount. Okay, so this is a fundamental difference. Okay, so again, we're going to start with figuring out what this target balance should be. And this is going to be your ending AR balance times some percent estimate. Okay, so again, we start with the target balance. We see what happened in the past, what our unadjusted balance is, and then we're going to figure out what this amount should be. Okay, so it's starting from a different place, right? We're starting with the target balance and we're backing into how much the adjustment should be. Is everyone following that? The difference between these two? Yeah? Okay. So in my opinion, this is a better way because you really just care about how much should be in that piggy bank, right? That's a more common sense approach in my opinion. Okay. And you're also gonna get rid of structural misestimates, because you can see in this case, we had 800 in our piggy bank. We actually had 900. So we didn't have enough in our piggy bank from the last period. We were off on our estimate by $100. We underestimated. Now, since we're starting with this, in this adjusting entry, we're going to get to this balance plus make up for this mistake, right? So in this adjusting entry for this period, we're going to correct the sins of the past, essentially. Okay? Or let's say instead of this being 900, this had been 500. Okay? This would have been $300. In this case, we overestimated. We had a piggy bank of 800, but actually we only took $500 of losses. In this case, we're going to benefit from that by taking a smaller adjusting entry here. Okay? We won't have to take as much out as an expense because we kind of are benefiting from this existing balance in our piggy bank. Does it make sense? Yeah? So again, I think this idea of figuring out what this ending balance should be and then figuring out based on that how much to adjust for, that makes more sense in this case of allowance for bad debt, in my opinion, and maybe yours too, if if you think about it. The other method, I don't know. I would need to hear a rationale of why it's a better method. I don't understand it. So if any of you can think of a reason why it would be better, you can tell me. Okay. Um, so I think we'll wait to start the practice problem. We'll start class maybe on Wednesday, just reviewing this in high level and then doing a practice problem using this other method, percentage of receivables. Okay. Any questions about the midterm? Any logistical questions?